changes coming. And as we move towards the end of the year into 2025, the economic and market landscape is shifting dramatically. Now that's what I want to spend more time on today, because generally we go through and do a quick recap of what's going on with the economy, but there are some significant things that are happening just in the last week and things we need to be thinking about going forward. Now, right now we are transitioning from lead 3 to lead 2. So the Lions Wealth Economic Activity and Development, and all of these stages are different aspects of the economy. What does that mean for you? For growth, for inflation that's coming in your portfolio? Well, that's what we really want to be talking about. And right now, we're still seeing growth of our economy decelerate. So this is definitely something that we have been noticing and is still a mathematical certainty, most likely on a probability front for the remaining portion of this year, because we're seeing that growth is slowing, but inflationary pressures are starting to rise. And we had the most recent CPI and PPI reports that are really showing the reemergence of inflation. And now that we most likely will be holding interest rates steady from here, we're starting to see a difference of the stock market itself and some of the complexities that are out there. So that's what we're seeing, but there is a silver lining. Yes, the risks are still out there, things are still happening, and the economy is turbulent still, but that may be actually shallower than what we expected. And this ping-ponging between lead 3 and lead 2 can actually create this volatility. But that's where we're here to help guide through some of the different things that we're looking at, the risks to watch, and then changes that you should be and can be making with your portfolios at kind of this point in time. So that's what we're going to be diving into today, and some of the action steps behind that with your own wealth plan. As we approach the end of the year and look forward to the first half of 2025, I've been talking about this, that we're still under some of these different changes of the economy, and there's a lot of transitions that will be happening on a monthly basis between lead 3 and lead 2. So that's where we're really starting to see that the macroeconomics are shifting dramatically, and for the several quarters to come, we can be seeing the oscillation really start to happen. But yes, there are some key aspects that you can be looking at. So growth right now, I talked about, is coming down, but that could start to pick up. Yes, it's inevitable at this point for most of the rest of this year, but there will be elements of lead 2 where we see growth happening as well. So on a smaller front, there will be some growth. On a quarterly aspect, we do see growth starting to slow even more. So that's one of the elements. But then we also are starting to see that inflation signals are starting to pick back up. And that's where we get the kind of analogy of stagflation, because we have a stagnant economy but growing inflation. And up to this point, and you may be reading it in the mainstream media, that we're not really seeing inflation, but that's the whole thing, that they're really only telling you what they want you to hear. Because if we're taking a look under the hood of all the different data points, yes, we're starting to see inflation keep up. And when we start to go into the next number of months and quarters to come, we can see it actually start to accelerate again pretty quickly. So that's where we have the lead 3 being shallow, because there's still some significance here, some significance that could actually, well, raise inflation more, raise bond yields more, raise the US dollar more, which actually can put pressure on a lot of different stocks, a lot of different asset classes, and we're already starting to see that. The CPI, the Consumer Price Index, just came out, as well as the Producer Price Index, and both of them are showing that they're starting to move back up. And that is what the Federal Chairman Jay Powell started to acknowledge by not acknowledging in his last press conference here a couple days ago. And what I mean by that is they removed all the language of inflation coming down, and now it's more of a wait and see. So that's something that, while he didn't say anything specific, they are actually starting to acknowledge that maybe they have cut interest rates too much right now. They may actually start to go the opposite direction and increase them. So right now, I do expect that they're going to maintain this current rate rather than continuing to cut the rates for the interest rates to come. Now, what this means is that we're coming into an environment that we can see that borrowing costs are going to stay elevated, that there's going to be other emerging factors with some government policies coming out that are going to create some hardships. So that's one of the areas. And with the new government efficiency department that we are starting to see the potential to have here in the course of just a couple months, and all the wave of policy reforms that are starting to happen, we actually know that there's going to be some uncertainty out there, that we're starting to see that all of these influences, both on the fiscal front and on the regulatory front, are going to create a lot of different hardships that are out there for certain sectors. So infrastructure could be a benefit, energy could be a benefit, and technology could be a benefit of some of these things. But when we take a look at all the different areas that we're seeing, and the fact that we're going between lead 2 and lead 3, well, that's a hybrid environment that we're going to be in now. And so what this means is that we're going to be going and flipping between them on a regular basis, probably over the next 9 months. And I call this a ping-ponging effect. And what this will mean is that we start to see the fluctuations really build up with many different sectors. So it may not be the stock market as a whole, but you're going to see huge swings in different sectors of the economy. So right now, you could say that it's essential to help look at and manage your overall risk. So sectors that are sensitive to interest rates. Sometimes it's technology, but in this specific instance, it's actually real estate that is going to be hit and hurt more so. And then we add in some of the other headwinds with sometimes commodities. So we can see right now that commodities have not been performing nearly as well. But if inflation continues to be there, it's because of the fact that commodities are going up in price. But there's another thing, gold. We've been talking about gold for the past number of months as a great way to hedge against this. But as we see these inflationary pressures build, gold can be there. But when we transition into lead 2, well, that means that we have growth, and gold does not like that environment. So it's actually started to either go sideways or starting to actually come down in price just because of these changes that are starting to happen. So gold actually may not be the best place going forward as a protection against some of these higher interest rates and higher inflation. Now, the rising rates really actually do create opportunities for us, because with some of the other aspects like gold that really doesn't have a yield to it, the US dollar is starting to gain strength. And what that means then is that we could see a lot of these economic conditions right for investing into the US, but ones that are correlated with the dollar, well, it could be domestic equities like the US equities here, but will be hurt when we take a look at overseas and the international and some of the emerging markets. So they used to be, even up to a couple weeks ago, a great place to be invested, because what is starting to happen is that if interest rates start coming down, there's a huge tailwind to these emerging markets. So think South Korea, think China, think Thailand and the Philippines, and a lot of the Asian markets that are out there. Not so much anymore. And the current environment that we're really starting to see has been changing, and that really means that we're going to need to make changes to the portfolios as well. So gold has been stagnant, so that's being reduced. The US dollar now is starting to be added in as a way to help to make at least a semblance of risk management happen, because we can't invest into bonds right now either. That's something that we've been looking at here, that gold's been our safe haven, because bonds, as interest rates rise, actually go down in price. So there are many more risks actually with bonds right now than many different stocks. And that's normally not the case. That is what inflation does. And we haven't seen inflation creep up like this and perhaps even be sticky for a number of decades. So interest rates will go up. The non-yielding assets need to be, well, starting to be diminished. Bonds should not be a part of the portfolios at any significant level right now. And then we need to take a look at others that are out there as well. Places for growth, places for protection. And I've talked about the US dollar because that is a thing that can be guarding against a lot of these other elements that are happening with high interest rates. And if we get the policies that the new President Trump, is expecting, then that actually could mean a continued strengthening of our dollar. So with that, then other assets that could go up with the dollar right now, cryptocurrencies. And I don't see that the need that we need to be going heavily into cryptocurrencies, because there is a significant amount of risk to them. And so it has to be something that you are willing to maintain that level of risk. But when we take a look at all the other elements that are up there, that's just one example of one that's going up with the US dollar. Then we take a look at utilities and consumer staples, and those are ones that should be working right now. But in this environment, there's an incredible amount of policy risk, and so they are not the places to be invested right now. Well, we're also taking a look at other sectors as well that can be helping for ways to be invested. And high interest rates that we are ones that sectors that have have high interest rates, they're more high sensitivity to interest rates going up, like I talked about with real estate. That's something we can't be, but we need to look at stable cash flows. We need to look at areas like energy that could be a huge headwind, or excuse me, a tailwind to what's going on. But with the policy risks of healthcare, of many of the other elements of what's going on with now RFK Jr. being put into place of the Health and Human Services, possibly even working with the FDA to make a huge amount of changes, consumer staples cannot be on the list either. So yes, policy risk is out there, and that's what we need to be working on. So we're going to be lowering consumer staples, lowering utilities, possibly starting to increase energy, because right now in an inflationary environment and coming into winter, this is historically a great time to be invested. So that's one of the elements. And we look at alternative investments. Private equity can be a great place, infrastructure, commodities. Those are all ways that we can be diversifying, but the timing has to be right, and the amount we invest into them has to be right as well, because those can carry significant risk if something changes. And that is going to be what we're seeing for the next number of months, that we're not going to have a definitive way forward with the economy. We're going to have a lot of changes. So what does that mean? And as we're starting to take a look at the economy, at your portfolios, we're also taking a look at your wealth plan. And building a robust year-end wealth plan is helpful as well. It's not just about the investments. We can actually talk about the protection plan and the practical steps you can do today coming into year-end. So let's cover the basics here of a good protection plan. Well, we have the insurances. Now, we need to make sure you have the correct coverage, because that's going to protect and guard against the what-ifs. So health insurance is a good start. Property and casualty insurance. All of these things are there, like even life insurance, to help fill gaps that may be if you are having something happen. So what I talk about here is that this is a way to make sure that you don't have unnecessary exposure, that you don't feel that you're going to have to use your assets to protect if something else crops up. That's what the insurances are for. Titling your assets are also incredibly good to take a look at coming into year end. So how is your home titled? Your investments, any business interests that you have, all of them we need to ensure that they have the correct ways that they're titled, so that we don't have any claims or disputes coming against them. Now, your home exemptions and all the other applicable areas you can be looking into as well. And according to your state, there's a lot of homestead exemptions that can shield a portion of your home's value from creditors. So that's another element to be considered. Well, when we look into retirement and college savings and all of these ways to defer money, we need to safeguard your long-term goals. So take a look at ways we can be putting some money aside, like an IRA, your 401ks, and even college savings plans. There are ways to optimize and protect against longevity as well. That's another element. Well, I've talked about life insurance as a way to use the insurances, but life insurance guards against your passing, and annuities guard against you living. So there's different elements that we can be protecting with these tools as well. Those are the basics. Let's go on to some advanced techniques as well. And we're taking a look at all the next level stuff, like your business, incorporating your business in a way that can help separate your personal life, personal finances from your professional assets. That'll help reduce liability risk. And then we need to insulate hot assets. And I call the hot assets like investment properties and other real estate that we can be shielding through legal structures like LLCs or trusts or even insurance policies. And we need to use trusts and other estate planning tools to help with the safeguarding of your wealth for future generations as well. So we look to minimize tax, protect what you have, and help guard against creditors, lawsuits, or anything else to come. And that is what a good wealth protection plan does, and that's why it's helpful as we're coming into year end to be adapting some of these strategies, to be looking at some of the ways that we can be utilizing these. And now is the perfect time to review your wealth plan with us, because there's a lot of tax implications that are out there, and your personal circumstances may have changed as well. So we just address some of these things proactively, make the changes that are needed, and right now is the time to do that. So when it comes to your wealth plan, having a second opinion can really make the difference, and our second opinion service is really designed to provide clarity and confidence in your overall financial plan. Now, here's what we'll do. We'll begin with a discovery meeting to understand where you're at today, the goals you have, and any challenges that you may be facing. And then we'll identify any gaps or opportunities to strengthen your plan. And this service isn't just for you, but for the ones you care about as well. Maybe some family members or friends or colleagues. And if you or they are feeling uncertain about their financial plan and way forward, please feel free to reach out, and together we can help create a brighter future for your overall wealth plan. And that is the power of protecting and growing your overall wealth. So please feel free to click the link below and set a time for us to meet. Take care.